I'm going to talk to you today about why it is mandatory that you have your planner, your investment advisor, and your accountant and lawyer for that fact, all on a team together working for you. So over the last several weeks, I've been talking about all these different credits and deductions available to you. And I'm going to talk today about how this all comes together and how this helps you save tax. So yesterday I was working on a true file with a successful business owner here in Saskatoon, and although the person's situation was a bit complicated, their personal tax returns aren't that complicated. And when I went through it and did a review of the tax returns on the personal side, I found several areas where we were able to save a lot of tax. So I'm going to just go through those with you and give you some examples of what I found. So the first item that was identified was the childcare expense. What was being done wrong is the childcare expense was being deducted by the higher income earner. This is incorrect. It has to be deducted by the lower income earner. The second huge item that I found was the carrying charges and the amount that was being deducted. As the planner, we are aware of carrying charges and what clients are doing to borrow to invest. So this particular client had borrowed and invested into a commercial building here in Saskatoon. The accountant did not know this. They didn't ask where the funds were being drawn from when they bought the building. This particular client has missed out on all the deductible interest for the expense incurred for this building. So it's been 2 or 3 years, so this person's missed out on just over $3,000 per year of deductions that they could have been claiming. And I will be recommending we go back and refile. The next item that I identified was medical expenses. So this person has medical expenses but didn't pass the threshold. This is where in a previous video we talked about the Personal Health Services Trust. This needs to be recommended by the accountant when they see medical deductions not being utilized within a tax return. The next item is donations. So this person didn't have a lot of personal donations, which is okay, but they were being claimed on an annual basis. What I would always recommend is stop claiming them, wait till you have a built-up amount, and then claim it in a later year when we can get you at that 29 or the highest federal tax rate. Then when I moved on to the wife's return, this is what I identified. Again, the carrying charges were incorrect, and I noted that the child had a disability tax credit. And I know this person was never recommended by the accountant to ever open up a registered disability savings plan. So again, missing out on potentially $3,000 a year in federal grant money. So this is the importance of how you need to know as the consumer all the different areas available to you to save on tax, because it's just not being asked by the accountant and you just don't know what to tell. So I just wanted to share this true life example and how this person, is missing out on potentially $7,000 or more per year in savings and grant money.